Welcome to the CoreLogic overview of Australian housing market conditions for June 2016. Following the 1.7% rise in capital city dwelling values in April, the May numbers were almost as strong, with the Hedonic Home Value Index rising a further 1.6% over the month. The latest results take the combined capital cities index 5% higher over the first 5 months of the year, which is in stark contrast to the final 5 months of 2015, where capital city home values actually fell by 0.2%. The recent rebound in capital gains is once again being driven by strong conditions across the Sydney and Melbourne markets. However, we've also seen a year-to-date growth of more than 5% in Hobart and Canberra. The only city where values have moved lower during 2016 is Perth, where we've recorded a 3.1% fall in values over the first 5 months of the year. The annual rate of capital gains is once again accelerating on the back of these recently stronger housing market conditions. Capital city dwelling values are now 10% higher over the past 12 months. Sydney and Melbourne have continued to see the strongest annual increases in home values, up 13.1% and 13.9% respectively. There's also evidence that value growth is starting to spread to some of the other capital cities, with home values 7.1% higher over the year in Brisbane, 6.1% higher in Hobart, and 5.7% higher in Canberra. Values have continued to rise in Adelaide, although the rate of growth has been moderate at just 3.9% over the past year. Home values have continued to fall in Perth and Darwin on an annual basis, down by 4.2% and 3.5% respectively. The strength in the CoreLogic indices is backed up by several other indicators. Auction clearance rates in Sydney have held in the mid-70% range since the last week of April, and weekly clearance rates in Melbourne have been higher than 70% almost every week during 2016. In comparison, clearance rates in December last year were consistently less than 60% in Sydney, while Melbourne clearance rates were tracking around the mid-60% range. Additionally, the number of events across CoreLogic's valuation platforms, which account for more than 95% of all bank valuation instructions, are up almost 7% during the month of May, which is the highest level of activity since March last year. The extent to which investors are fueling the latest surge in home values is hard to quantify without recent data. However, housing finance data to March shows that investors, as a proportion of all new mortgage commitments, have been trending higher since reaching a recent trough in November last year at 42.9%. The March data shows investors now comprise 47.6% of all new mortgage commitments, the highest proportional reading since August last year. Anecdotal evidence suggests that investor numbers may have increased further since this time, with some lenders loosening their lending policies for investment purposes as growth in investor-related credit tracks well under the APRA speed limit of 10% per annum. Lower mortgage rates are also likely having a positive effect on consumer confidence and housing market conditions, with the standard variable mortgage rate now at its lowest level since 1968. Although home values are continuing to rise, it's a different story across the capital city rental markets. Across the combined capital cities, rental rates have fallen by 0.3% over the past year, setting a new benchmark for the weakest annual rental change on record. While rental rates are falling, home values are continuing to rise, and subsequently gross rental yields are continuing to trend lower. Gross rental yields across the combined capital's dwelling index are currently recorded at 3.4%, having fallen from 3.7% 12 months ago. Home values in Sydney have increased by 7.7% over the first 5 months of 2016 and are 13.1% higher over the past 12 months. The annual rate of home value growth has slowed significantly from its peak growth of 18.4% in July of last year, but has accelerated from a recent low of 7.4% in March earlier this year. Auction clearance rates in Sydney have held well above the 70% mark through May. However, the average selling time remains higher than a year ago, with a typical Sydney dwelling now selling in 39 days on average, compared with 28 days a year ago. Discounting rates remain low at 5.1%. However, with the number of residential properties available for sale now 26% higher than a year ago, we may see the Sydney housing market shift more in favour of buyers over sellers as the year progresses. The ongoing diversity in the housing market highlights the different growth drivers that are evident from region to region. The economies of Sydney and Melbourne remain relatively sheltered from the downturn in the resources sector, and they've benefited from a very healthy services sector and positive population inflows, while the mining states and territories are experiencing softer economic conditions, as well as a sharp wind down in population growth, particularly from overseas migration. Although housing market conditions appear to have picked up over recent months, I would be surprised if we saw such a strong pace of capital gains being sustained. Affordability constraints in the largest cities are likely to be one of the factors standing in the way of further gains. Sydney dwelling values have increased by 58% over the past 4 years, and they're 86% higher since the beginning of 2009. Although affordability factors aren't as pressing in Melbourne as they are in Sydney, dwelling values have increased by 71% since the beginning of January 2009, and they're 39% higher over the current growth cycle to date. Additionally, lending policies are now tighter than they were a year ago, with most banks requiring higher deposits and becoming more risk averse, particularly within specific new unit markets and in areas that have seen rapid appreciation of values. The low rental yield profile may add some further disincentive to investors who remain a substantial component of housing demand. Yields are compressed across most of the capital cities. However, gross rental yields in Melbourne and Sydney have fallen to new record lows over recent months as capital gains substantially outweigh rental gains. In saying that, investment in housing is likely to remain a popular investment option despite the low yield profile, as long as capital gains remain strong. Relatively safe asset classes like cash and bonds continue to offer up little in the way of returns, and the volatility in equities has likely shaken the confidence of some investors. Some lenders have recently relaxed their previous restrictions on loans for investment purposes, which could result in a rebound in demand from this segment over the coming months. Thanks for tuning in to our monthly housing market update. Remember, you can find more detailed analysis and commentary at our website www.corelogic.com.au.